The RBI has now announced a 10,000 crore OMO that is just yesterday, and that's the amount that they are going to buy, worth about 10,000 crore rupees. The move is going to help banks book gain or reduce losses as well. Moses Haring, Executive VP as well as Head Global Markets Group at IndusInd Bank joins. And Moses, hi, morning. Firstly, does it seem like a surprise move from the RBI? And more importantly, what do you think it is going to do for the bond market?
No, it was not a surprise. The expectation was that RBI would come in with either comforting statements or some kind of actions to prevent extended weakness in 10-year bond yield above 8.65%. Because the market expectation of a quick run into 9% in probably first quarter of FY13 because of the supply side pressures. And also post mid-quarter policy review and the budget, things are very pessimistic at this stage, both on the market front and the Indian economy front. So there are no great positive factors from the bond market. And given the RBI's reluctance to shift into aggressive growth supportive policy, bond market is expected to stay weak at least in the first half of FY13 till clarity emerges on factors that are considered major risk to inflation, such as the weak rupee, crude oil, etc. So I think RBI move was timely. The purpose may be to help banks to reduce mark-to-market losses at the fag end of FY12 and also to push through the first weekly auction of 18,000 crores in the new financial year. So that should provide a bit of relief. But having said that, it's not getting the market into a bull run. I think 850 should be a strong and would look for 850 to 865 consolidation.
Moses, I want to come in. I appreciate that. The question mark really is that a couple of traders did say that it was a surprise because it was announced on the last day of the fiscal, and what this also could do is resist a lot of short traders from growing a blanket short, because the RBI is now saying that they are not averse to making such surprise moves.
See, last year, because of 1.25 trillion OMO, RBI managed to push the 10-year bond yield from close to 9 to 8%. But that was also triggered by aggressive rate cut expectation. But there has been a significant dilution in rate cut expectation. Most of the analysts have cut their expectation from 150 basis point to 50 basis point. So having said this, RBI has to keep the OMO in place for FY13 and also combine with CRR cut and rate cut to provide a kind of stability in 10-year yield around 835 to 850. So we have to see how aggressive RBI is going to be in its OMO operations.
Right. So Moses, with this 10,000 crore OMO, and like Neeraj just pointed out, the timing of it really, does it seem like the RBI is more interested in being debt manager than anything else? And what does it lead up to in terms of what the central bank action is going to be in the April policy?
The main objective in my view is to provide a soft landing for FY12 end, so that 10-year yields don't flare up beyond 865, 875, pushing banks into huge mark-to-market losses. Banks are already under NIM pressure because of the high cost of funds since December 2011. So that may be to help the financial system. Number two, to get the first auction sail through smoothly.
Okay, Moses, we'll leave it at that. Thanks so much for joining in.